I would always ask other people I would meet who are entrepreneurs how they value a business. And there are a lot of different ways.
I believe that every time you bring on a new investor or partner, capital partner, you've got to have a plan for them to get a return on their investment.
In South Africa, there aren't a lot of big tech companies with ginormous valuations, and local investors and VCs and companies who may buy your business are not going to value you on global tech valuations.
The goal with Exit Strategy is to create an educational platform that helps business owners and founders develop skills that will help them get their businesses sold.
Vince, welcome to the show. It's so great to have you as our first guest on the Exit Strategy Partners podcast. This is very exciting for me because I've been wanting to do this for a while, and my own journey of thinking about how to sell my company and how to exit has been really interesting, and I've learned a lot. And I realized, there's a gap in the market in terms of educational content for business owners, for entrepreneurs, on how to go about the exit process and how to actually realize the liquidity event and what happens afterwards. So, your story with bottles and exiting to Pick and Pay is a really interesting one. So yeah, welcome to the show. Great to have you on board.
Thank you for having me. It's an honor to be your first guest, and looking forward to it.
Great. So yeah, I think a great place to start is obviously for you to tell the audience a little bit about your background and what actually led you to starting Bottles.
Yeah, sure. I grew up in Cape Town. I was fortunate to study at the University of Cape Town, a business science degree. At the time, I think I didn't know what I wanted to do with my life, so I kind of just picked what I thought at the time was the easiest option. I picked marketing and a business science degree, and that kind of fortunately led me to start my career at a company called Unilever. An amazing place to start your career. I think their ability to take young graduates and give them a lot of responsibility from a really young age is really how I cut my teeth and learned my craft. And in the marketing world at Unilever, you are leading a business. You're not just doing marketing. That's like one of your side functions. So that was amazing. During my time there, I think I grew very quickly. There was a lot of structures and processes I learned on how to run a business. But I got to the point where I felt I had outgrown what I could learn there because I wasn't able to progress fast enough in a kind of corporate ladder environment. And that kind of led me to go, I want to start my own business. This was back in 2015. I guess the time we figured, hey, let's start an app. And it was myself and a friend, Enrico. Neither of us were technical people. We were both kind of marketing business backgrounds, but 2015 it was like, okay, let's start an app. What are we going to do? And we were throwing around many ideas back and forth. And we came across an app called Vivino. And Vivino at the time was kind of like the social media platform for wine, where you could scan a label of a wine bottle, you could get ratings and reviews. And the missing part for us was like, why couldn't you then just order the wine and get it delivered?
It's true.
And then from there, I think the idea evolved a bit further. We were at a bride, a friend's house in Durban. We ran out of drinks. We had been drinking. We couldn't drive to the bottle store. We were like, this is the idea. Who hasn't wanted to press a button and have drinks magically arrive within 60 minutes? So that was kind of the genesis of the idea.
How old were you? How old were you at the time?
I think this was in 2015 when we came up with the idea. So that's 9 years ago. I was probably around 30 years old. I was a brand manager at the time. It feels like a very long time ago now. And it's crazy because I look back at that and I was very young and naive still. But in a way, that was a good thing, because knowing what I know now, starting a business would maybe be infinitely harder. The naivety and the passion and drive I had back then allowed me to not look at the risks and the fear and rather look at the opportunity.
I can resonate 100% with that. I mean, when I had a similar story of leaving a job to start iExperience, and I think back in the beginning times, and I was just like fearlessly doing things without thinking about, could this go wrong? Could this be bad? And I think that courage and that like almost naivety, as you say in the beginning, is almost like a strength, because you're able to overcome like mega challenges without worrying about, the downside so much.
No, I think that is a huge strength. Yeah, I look back at that and I go, wow, we were completely fearless. And there was no challenge thrown at us that we didn't go, shit, we're going to overcome it. You take knocks all the time starting a business and you think everything's over. And maybe you have a few days of being depressed or a week of being depressed. But every knock, I feel like you get hardened and you pick yourself up quicker. Um,
Mm.
but it's funny because everyone gives you the advice when you're starting a business. Well, I don't know. For me, I got a lot of advice from friends or people who had started business, and they tell you all these cliche things, like how hard it's going to be, and you hear them, you're like, yeah, whatever. And then going through the process, you understand those are all right, but you also realize that you could never understand the cliche saying until you go through it yourself. If that makes sense.
100%. No, it makes perfect sense because I've said to a lot of people that I had mentors when I started my business, and they would give me advice, and I would think, what do these people actually know? And then everything they told me was 100% true. You know, they said, take your time with hiring, bring on the best people. And every time took a shortcut and didn't do that, it cost me a lot of money and a lot of time and a lot of stress. And I thought back and I was like, you know what? I wouldn't have known this if I hadn't gone through it. I had to go through it.
Yeah, exactly.
Great. So yeah, really interesting story going from corporate into the startup world. It's a big risk. And then so you started the company. What were some of the big milestones that you achieved in the early days?
Um, we were fortunate enough to have a mentor at the time we were looking to start. And I think what he did for us is we would meet with him maybe once a month or once every 3 months and bring to him an update. We still had full time jobs at the time. I had left
Mm,
Unilever, I'd moved to Google. My co founder was running a digital agency. This was a bit of our side hustle. And something I'll always tell people is if possible and you're going to start a business, start it as a side hustle and build it to a
mm,
point where it becomes your main hustle. It can be difficult to leave a job and then start your business at the same time and have all that pressure on you and the need
yeah.
to start earning money. I think that's tricky. So we were starting this on the side. We would meet that mentor, and every time we'd come to him and present an update of where we are, and he's like, "That's great, but now you need to do all of this, and then come talk to me." And then we'd come to him again. He said, "That's great. Do all of this, and then come talk to me." So for us, I guess the first biggest challenge was we had this idea and we needed to find developers.
Mm,
We weren't technical people, we were business people. And in 2015, finding app developers in South Africa was like impossible. I mean, I remember one of the first guys I met told us he had built an app for a global artist called Neo. And we were like, oh, that's really cool. And then you meet the guy, and it's like, this was not Neo's app. He had just built an app with Neo's face on it that told you like some of his songs. It was random. So finding
mm,
developers was really difficult at that time. And to paint the picture, this is 2015. There are no on-demand delivery apps in South Africa yet. Mr. Delivery is still a menu that lives on your fridge that you phone in and they come and deliver to you. Uber Eats doesn't exist in South Africa yet, right? So it was a very different time. And we took a few months, I think, to really build a business plan and then find developers. We found some guys in Durban who had never built a customer facing app before, but they built some other technology and they told us, listen, we get your idea, we can build it for you for pretty cheap. Um, and that, I guess, was like a key milestone for us. We figured this is how much money we're going to need to start it. We found some developers who would do it, and we built what we called then an MVP, a minimum viable product. What is the most basic version of this thing that we could build that could kind of prove this concept that it could work? I think at the time we were still a bit naive on what an MVP was, and we overscoped completely what we wanted to
yeah.
build in our first version. We didn't even understand the need for a backend. We kind of scoped out what an ordering app would look like for customers to order alcohol and get it delivered in 60 minutes. We had no clue that we would need an entire backend that would manage things like a menu, pricing, would manage logistics, all of that piece. We just wanted the fancy front end piece. And our developers, fortunately, had the foresight to go, no, you need to build this whole second part of it. They estimated to us that development was going to take 3 months to get 95% completion, and then with testing, another 3 months to get 100% completion. First learning I had with working in tech is basically any timing developers give you, double it at least. And that's probably a more realistic estimate of where you're going
A
to end.
hundred
So
percent.
what
A
should have
hundred
been
percent.
a 3 to 6 month journey ended up being a 13-month journey before we actually had an app that was ready to launch. Um, And yeah, so I think one of the biggest milestones in the early days was we got an app onto the App Store. We, at the time, were kind of living in Joburg, and myself and my co-founder Enrico were traveling bottle store to bottle store because, again, on-demand delivery didn't exist. We were going to a bottle store and going, hey, we want to help revolutionize how you do business by bringing you more customers and allowing them to order online and collect from your store, and we'll deliver to them. And I think the first 10 stores we met were all like, you guys are crazy. No one's going to do this. It's not going to work. But we found one guy out of those 10 who said, I think this is the future. I believe in this. Let's do it. And we signed up our first bottle store in Bryanston, Coachman's Wine and Liquor, and went to their store, built the menu, built the pricing, set the system up, and it was there, right? We were testing a few orders ourselves between us and our friends to just see that everything worked, and it was working. And I think the biggest and most memorable milestone for me in those early days was receiving our first order from an actual customer, right? I was still working at Google at the time. I had been meeting customers, and I was driving back to the Google office when I get a WhatsApp message from the bottle store saying, there's an order. I pulled over on the side of Stanton Drive, looked at my phone. I said, well, I didn't order. I called my co-founder. I'm like, did you order? He's like, no. I called the store. I said, can you check who this order is? And they're like, her name is XYZ. It's like, this is the real order. And we were kind of faking it till we make it so much that we had no plan at that stage for logistics yet. There were no on-demand logistics companies who could do our deliveries. Our plan was to do the deliveries ourselves. But now I'm kind of far from the bottle store and having to go back to the office. Enrico's at his job. So we kind of had to go, what are we going to do? And in that moment, we decided to book an Uber to the bottle store, phone the Uber and say, listen, I have an order there. It's not for me. Please just go inside and grab it. They know you're coming. And then you're going to deliver it directly to my customer for me.
I love
and
that.
the
That's
Uber
innovation.
said yes. The funny part about that is we actually, for probably a year and a half ahead, continued to do that because we still struggled to find a logistics solution. And we partnered with several startups who were trying to do logistics and who were very early stage, and none of them could scale as fast as we were scaling. So while we were trying to build an on-demand logistics piece with kind of scooters or bikes, we still carried on doing this manual Uber process in the background. So like to a customer, it worked well, but behind the curtain, it was chaos. On a Sunday, managing orders on my own at one stage, you'd have like 10 phones and 30 orders across 10 phones. And like, it was just chaos. But that's kind of part of your journey, right? You gotta fake it before you make it and figure out how you're gonna do things as you go.
Yeah, they always say do things that don't scale. And then, once you've gotten to a certain point, you start figuring out scalable solutions. So yeah, that's very innovative, getting Ubers to deliver your bottles for you. Brilliant. So yeah, that's a great starting story and an epic milestone to be one of the first companies in South Africa to do deliveries. Did you think that when you started this company, did you think that you were going to sell it? Was that like part of your plan, or how did the decision to actually sell your business come to be?
Look, I think every entrepreneur probably dreams about selling a business one day. And for us, I think we definitely had the ambition to exit and sell our business one day. Bottles for me was a starting point for an entrepreneurial career. I did not think this was going to be the company that was going to be the be all and end all that I was going to spend the rest of my life in. It wasn't necessarily my biggest passion, but I think we needed to just try something. And at the time, someone gave me the advice of ideas are worthless, execution is everything. And we had what we thought was a good enough idea to try. And I had a partner who was extremely good at bias for action and getting things done. So we just went ahead and executed. And that learning really sticks with me because in the early days when we just launched, I had at least 50 people on Facebook or wherever get hold of me and say, you stole my idea. And we're like, I've never met you. I don't know you. And this is the reality. An alcohol delivery app, delivering alcohol in 60 minutes through an app is not a unique idea. Plenty of people have had it. Plenty of people may have had it at the same time. It had started globally in other markets at a similar time. It was not a unique idea, but ideas really are worthless. Execution for us is everything. And it was that we just started and went ahead. But it was, I guess, always our intention to build something, to scale and then exit. And we wanted to use this business as a stepping stone for us to be able to do bigger and better things that were more around making a difference in people's lives. But in order to do that, I guess we were looking for some level of financial freedom that hopefully selling a business would get. So that was definitely our initial intention.
And did you guys self-fund the business, or did you have any investors or VC funding to grow it?
Yeah, look, initial funding, I was 100% at risk, if I'm honest. I borrowed 50 grand from my sister. I took 50 grand out on a credit card, and that was my 100 grand. My
Wow.
co-founder, he put 100 grand, and we had 200 grand to start to try and build an MVP. After building an MVP successfully, I think it cost us probably around 250K for the first year to get an app out and to just put a little bit of money on marketing to start the thing. We then went on to Shark Tank, and it was the first season of Shark Tank in South Africa, and we got accepted to go on the show. We had kind of been running maybe for 1 or 2 months now with actually accepting customers' real orders. Went on the show, and that was how we got our first round of angel funding. We got 3 offers on the show, and we took an offer from one of the guys, which gave us our first round of funding, and that allowed one of the 2 of us to actually quit our full-time jobs and take on running the business full-time. I think from there, I guess that money allowed him to focus full-time and for us to get our second employee in and to start scaling this thing. And look, it was scaling pretty well quite quickly. Our first investors then helped us get a second round of investment, and we were able to bring in a company called Norman Goodfellows, who were kind of premium wine and liquor experts. They had 9 stores across the country. They were kind of the second round of funding we got. And that then was the trigger for me to actually quit my job and join full-time too. And yeah, I think from there, an e-commerce business is a difficult business to run. It is not an easy business to get profitable quickly. So I think one of our challenges is that we never really ever raised enough capital for us to not run out of time eventually. So we had to raise a third round of capital probably 2 years later, which we did from another private investor. So we had kind of 3 rounds of I don't know if you'd call it angel or whatever round, but we had 3 rounds of private investors coming into the business prior to then exiting to Pick n Pay a few years later.
So that's interesting. I mean, I believe that, every time you bring on a new investor or partner, capital partner, you've got to have a plan for them to get a return on their investment, So every investor has different timelines, different expectations. I think in the early stages, it's small amounts of capital, but, hoping for big returns. But, on the third round, I'm sure then, the investor was like, okay, well, what is the plan? How is this capital going to be deployed? And, when we do eventually get to an exit, how do we agree to that in terms of how the shareholder agreement is set up? So, did you guys discuss a shareholders agreement and a process that if you were to sell, whose decision was it? Was it your and your partner's decision, or did everybody have some kind of say in that process?
Yeah, good question. And I guess a lot of learnings we had there because we honestly had no idea about any of that. Our first 2 investors were 2 successful entrepreneurs who I think one of them was a personal mentor for me. And the great thing about that is I think he wasn't investing in our business to really get a big return. He was investing because he believed in me. And he played a lot of open cards with us, but they actually helped us create our first shareholder agreement and a proper kind of memorandum of incorporation and all of those kind of rules. And they set very clear rules in the learnings they had, which to a large degree meant that I think you needed 80% to 80% voting rights to be able to get anything passed through our board, right? And the power there was to ensure that as founders, we didn't have the ability to do anything we wanted, and that we needed a broad kind of a broad alignment from the majority of the board before making any big decisions like exiting. And then subsequent to that, every additional round, an investor, I think, because that first agreement was quite stringent, was kind of followed that. But to your point, our last round was a significantly higher amount of money for that private investor,
Mm.
and he did have expectations on what he was going to get from that. And I think every round it gets a little bit more intense, and their expectations and how they bring those through into the legal documents and contracts and agreements you sign come through. And if you don't know what you're doing there and you don't have good legal counsel, you can potentially sign away things that are going to hurt you very much
Yeah.
later down the line. One of our investors shared a story on his side of how a 2% shareholder nearly tanked a massive deal for their company because of exactly that. They did not. They signed a contract with that small minority shareholder that gave them voting rights that they didn't think that they would have, and then they were able to veto a deal. And I think in the last minute they actually got them to on board with the deal, which was good. But those things are really important, and I think you don't understand them as an early investor. And legal fees are expensive as fuck.
Yeah.
I'm gonna be honest.
Yeah.
It blew my mind. You're paying tens of thousands, if not hundreds of thousands of rands for contracts and legal agreements. And when you're an entrepreneur in the early stages and you don't have a lot of capital, you're not paying yourself a big salary, paying that amount of money to lawyers, you're like, what are we doing? Like, how is this fair? But it takes one horror story, I think, for you to realize how important that is.
Yeah, I think it's interesting because when you have a shareholders agreement, that the whole point of the agreement is for the shareholders to agree on big decisions. And obviously one of the biggest decisions that you can make is selling your company. And I think it will always come down to, okay, well, is this the right time to sell? Is the valuation right for all the investors to get the return that they were looking for? And if there are disagreements, that's something that I think should be discussed beforehand. Setting some kind of goals as to, okay, well, the money's coming in now. We've got a 3 to 5 year time horizon to execute the strategy. These are kind of the ballpark figures, what we're aiming for in this exit. These are the potential strategic buyers that we're going to be looking at, or the private equity companies. And that keeps everybody focused and on the same page. So I agree with you. When we raised capital for our experience, $2.5 million, I just didn't really actually have a good understanding of like how to deploy that capital to get a reasonable return on that investment for our investors. My mindset was more around deploy capital to grow. But I think, a very good idea would be to sit down and reverse engineer how that capital gets deployed into value, into some kind of valuation for your business, that in the future, if you sell it for this price, your investors are going to get this kind of return. Otherwise, they can get quite can be quite a contentious environment where they're like, well, I've put this money in, and the valuation that we're getting here is not right. We need to shift things up. Maybe it's a good time to transition into that actual process, where I know you have a very interesting story with COVID and a quick turnaround, and how the sale actually happened. And I'd really love to dive into that, and what triggered that rapid sale.
Yeah, sure. Look, we through our journey, we had quickly realized that we wanted to find a retail partner, because signing up one bottle store at a time, having to build a menu and pricing for each store, having no integrated system for managing stock on hand and pricing and invoicing and payments, was manual and tedious in the early phases. And we realized, look, that wasn't a way to scale it. So we went and actually approached multiple retail partners in around 2018 to be able to scale our business faster. We met with Pick n Pay in 2018, and we agreed a deal with them to pilot in 4 of their stores in Joburg. And as part of that pilot, we actually integrated into their inventory management system. So we were getting a live feed once a day of their full menu, the stock on hand, the pricing, etc., which was making it much easier for us to scale. The pilot went really well, and we rolled out from 4 stores to 60 liquor stores across the country.
Wow.
And the business was scaling pretty well at that stage. And look, then came COVID. And in March 2020, on the Monday, just before lockdown happened, the government in South Africa announced a ban on the sale of liquor that was going to kick in from the Thursday, right? At that stage, the entire South Africa starts panic buying. And COVID's already happening, so people aren't wanting to go panic buy in stores. They come to our app. We are the alcohol delivery app in South Africa at that stage. So that Monday to Thursday, our volume went nuts. And we were struggling to keep up with it, to be honest. And the stores were flooded, our systems were flooded. It was crazy. And at the same time, we knew on Thursday, liquor's done. We can't sell liquor anymore, at least for a month, and we don't know what's going to happen. So I guess those 4 days were a wild ride. Come Thursday, last day of liquor sales, we closed up shop. We had already started meeting with Pick and Pay that week to say, guys, we know liquor sales are closing. Apologies, my cat wants to be part of this interview.
That's
Just give me
funny.
one sec. Come the Thursday that week, we get a meeting with Pick and Pay, and I think it was kind of serendipitous because at the stage you had a global pandemic, customers were worried. Our on-demand delivery system had taken off, but now liquor was going to be closed. Pick and Pay had a scheduled e-commerce website, and they had a 14-day wait time to get a delivery because it had also gone crazy. So we kind of met Pick and Pay and said, look, we have an app, we have a system, we have a team, we have logistics, we have everything, all of the building blocks we need to do grocery delivery. Your system has got a 2-week delay, and right now, more than ever, customers are wanting to get their groceries delivered to their homes so that they can stay out of the public. Can we come together and pivot this business? We agreed commercials on the Thursday that liquor was being banned while trying to run and get all the last orders delivered. On the Friday, we started switching off all of the liquor part. Luckily, that stock feed that we had gave us everything. So we built some quick software that said, hide all the liquor and now take all of these new items in. But that meant us building an entire new menu structure, naming, descriptions, images, everything for an entire grocery menu. We started on the Friday, we finished on the Sunday, and in just 4 days, we pivoted from a liquor on-demand delivery app to a grocery on-demand delivery app in partnership with Pick and Pay. We went live on that Monday with our first 2 stores for grocery. By the end of the second week, we were in 90 grocery stores doing on-demand delivery of groceries. And as wild a ride as it is, I look back at it and I can't believe how we even did that, because we were in 60 liquor stores that we went to every one of those stores ourselves to sign up and train and get running on our system. And then a global lockdown happens. We rolled out 90 grocery stores virtually. We trained every store on WhatsApp calls or Zoom calls. And we did everything virtually, and it worked. And this thing just went crazy. In April, we grew 600% on March. On the previous month, not year on year, on the previous month.
You mean in terms of revenue growth?
That's just in order volumes.
Order volume.
Literally, order volumes grew 600% in the first month, and it didn't slow down and stop. So this thing just really went nuts. And I think it was a weird time, if I'm honest, because at the same time, so many people were losing their jobs, so many businesses were going under. People were panicked. Life felt insecure for the first time, that it never had before. And yet, for our business, COVID fast-tracked e-commerce growth in South Africa by at least 5 years. And our business really took off. We scaled our team. We doubled our team in the space of 2 months. So we were creating more jobs and hiring more people and just trying to keep up with this exponential growth, while at the same time, I think the market and the sentiment and other people were in a very different space. So it was weird being like a success story in such a difficult time. But it was a wild ride. Pivoted in 4 days.
So interesting, because my business, which was essentially travel education programs for American college students, was doing so well right before COVID. We were on track to potentially hit $4 to $5 million of revenue. We were profitable, and then within 2 weeks, the whole business shut down to zero. We had to refund everybody. And just like you're saying, we had to completely pivot, and we pivoted into online learning. but we did it all virtually, like in a lockdown environment. And I often think back and I'm like, how did we like move so fast and create a new product and start selling it in such a short space of time? I mean, I've tried to recreate that energy, but it's actually quite difficult.
You can't.
So yeah, it's interesting. I think in times of crisis in business, you have to dig so deep, and it comes down to survival that you can really produce an incredible amount of work. So your story is amazing. That pivot from selling alcohol to going into grocery sales is genius. It was brilliant.
Yeah, look, I think it was an easy pivot in terms of the idea, but to your point there, I think what drives people more than ever is having a mission. And at that stage, our mission was we had 30 people working for us. We needed to secure their jobs and livelihood. We had spent 4 or 5 years building this business, and we wanted to save our baby basically from what we thought was imminent extinction. Um, and we also felt that we had a mission that we could help keep South Africans safe in their homes by still bringing them their essential grocery items.
Mm.
So that really gave our team a purpose. And that meant I didn't have to ask people to work weekends and nights. They worked weekends and nights willingly because they believed in our purpose, they believed
Yeah,
in our mission, and they were as invested, our team was as invested as we were in that. And to your point, that you can overcome almost anything with the right motivation. But sometimes that motivation needs to be forced upon you in
yeah.
circumstances like COVID.
Yeah, it was an interesting time for sure for a lot of businesses. So, can you walk us through your exact sort of selling process from start to finish? From like, okay, you had the conversation, and then you obviously had to go through a specific process. And the real point of this podcast is to demystify the exit process. Like from that conversation to closing the deal, so many things happen and so many people are
Mm,
involved, and so many decisions have to be made around pricing, lawyers, what is the post-sale plan? Is there an earnout? How does that work? So I'm sure that little piece of time must have been really interesting for you, especially if you hadn't actually done an exit before. And the goal here is that for an entrepreneur looking to exit, to really demystify this and understand the intricacies of how it actually works.
yeah. For us, I think the process start to finish was around 6 to 9 months. We pivoted the business in April 2020 and we finalized the exit in December 2020. Um, the start of the journey really was post the pivot and this thing scaling so fast. We kind of sat with Pick and Pay and said, look, this makes sense, but we are so tied to them, and we needed to be able to, I guess, get closer to them to be able to improve the service because the service was breaking. Right, we are fulfilling orders from Pick and Pay stores, and we're scaling so fast, and their staff can't keep up with it. And we felt that it was just not going to work this way. And the growth also meant we were burning money faster because we hadn't built scalable solutions everywhere yet. So exponential growth, exponential burn, we were running out of cash too. So it was a bit of a business need for us to actually exit at that stage. We Pick and Pay approached us to say they were interested. We took that decision, or we took that news to our board quite excitedly, and we sat down with our investors. Our investors, fortunately for us, were all successful entrepreneurs previously and currently, and I think they were able to give us some good advice and guidance through the process. The first thing they said to us is you need to get a broker or an M&A guy who's going to help you. And they gave us two recommendations. So we actually interviewed both, and they kind of pitched to us why we should work with them. Each had different kind of ways of working and rates. And in fact, we actually went for the broker who was more expensive, but felt to us that he would really have our best interest at heart and would be the better person to work with through the process. And I think that that's an important thing to say. Don't just
Mm.
go for the person who's going to give you the best deal or the cheapest deal, because there's no more important process or difficult process you're going to go through than that. So
So
that was
what
the
what
first part.
were what were the terms with the
Yeah.
broker exactly that you agreed upon?
So look, most brokers want to take a percentage of the deal, and you can find brokers that are going to go as low maybe as 1 to 3%, and then you
Mm,
have brokers that are going all the way up to 10%. We negotiated, I think the first broker wanted, I think, 3%, and the second broker wanted 7.5%. We got the second broker down to about 5%. And he felt like the better fit. For us, what was really important is we met both and we really got along with him well. He had a track record of doing this well for our investors and many other businesses. And that felt right. It felt like a lot of money at that stage to give up when in a fictitious deal that we didn't know anything of, we didn't know what the valuation was going to be. But I look back at it and I go, I'm very thankful we chose that broker, not the other one, because I now know how hard that process was. And he was more than just a broker or an M&A guy. He was almost our therapist and
mm.
confidant through that whole process. The only person who I think was actually on our side throughout the process, because at some stage you've got the buyer pushing you really hard, you've got your investors pushing you really hard, and you're stuck in the middle. And he was the person we could always go to that was gonna have our side in the conversation, or at least that's how we felt.
Yeah, that's interesting. I think the choice of broker when you're thinking about it, exiting is such a critical decision. So, my recommendation would be to get references and meet with someone who, somebody who knows somebody who's worked with this person and has had a positive experience. Because, that person can influence the sale price by quite, an amount, and also have quite a influential factor on the terms that get agreed to, post sale. Because if they're on your side, they're playing a role of elevating your status to the buyer, but then also negotiating the better outcome for you. So yeah, I think
Yes.
that was obviously a good decision on your side. Okay, so maybe we can dive into the valuation side of things, because I think this is also quite a confusing thing for entrepreneurs to fully process. When I started my entrepreneurial journey, I just didn't really understand valuation that well. And I thought, the business was worth hundreds of millions of dollars, and, I'm going to grow to a billion rand company, and it's going to be easy to do that. But, you get a bit of a reality check when people start putting pen on paper and saying, well, this is what your business is worth. We don't really care what you think it's worth. We use a simple multiple of your profit, and that's where we're looking historically, not at the future. And this is kind of a number that we're willing to offer. And that can be quite different to maybe expectations in your head when you get there. So what was your experience in the valuation process?
Look, it's an interesting one because I, throughout having a business and starting a business and going through that process, I would always ask other people I would meet who are entrepreneurs how they value a business. And there are a lot of different ways, different methods, and it depends on your business. I mean, the most common ones are multiples of your turnover, or multiples of your profit, right?
Mm,
And to your point, it could be future or past or a combination of both. Um, we built quite a rigorous model that looked at starting with marketing spend, cost per acquisition. A cost per acquisition would tell you how many new users you would get. Retention would tell you how many you keep. Order frequency would tell you how many orders that place. Average order size would give you that. And we had a very rigorous model that then could tell us exactly what our turnover would be by month based on our marketing spend that we were putting in. Because we were doing only digital marketing, only performance marketing, and we had very clear metrics on that. And we had very clear metrics on our users historically. So we kind of used that to project 5 years into the future based on what our marketing spend primarily would be, and what changing behavior would happen with our users to predict turnover. You've got a bunch of variable costs linked to that, and you've got a bunch of fixed costs on that, and that helps you build an entire kind of projected P&L. And we were wanting to base our valuation on a 5-year projection into the future, primarily on sales or profit. At that time, we were not profitable. So a 5-year projection on or a multiple of your current profit for us made no sense.
mm, mm,
But a projected version did make sense because we believed we could get profitable quite quickly. To your point, the buyer didn't want to view it that way whatsoever. They wanted to look at historical P&L, not projected P&L. And one of the other factors that we struggled with was we were an alcohol delivery app that pivoted into grocery and then scaled phenomenally uh, with a partner who helped enable that. The partner, being Pick and Pay, felt that they had helped save our business from impending doom and would not value us on the growth that we had achieved post the pivot. They would only value us on the scale we had delivered pre the pivot and what that was projected to do if we had not pivoted. So we had a very big departure in how we wanted to value the business versus how Pick and Pay wanted to value the business, which I guess is going to be normal. I think some of the other challenges in valuing a business is in South Africa, there aren't a lot of big tech companies with ginormous valuations. So if you look a lot to America or Europe and you look at the valuations and the exits and the prices people pay, they're astronomical. And if those are your expectations, the challenge with that is in South Africa, it's not the same. And local investors and VCs and companies who may buy your business are not going to value you on global tech valuations. So you've got to kind of probably put that down, or look for global investors who would think of your business that way. So we had to manage our expectations down significantly, and really then it became a debate about what projection model and what level of confidence there was in that model. And ultimately, it was more about what the buyer was willing to pay than what story we could tell, to be honest.
Yeah, yeah. And what was the most surprising thing for you as someone who hadn't really sold a business before as you were going through this process? Because I'm sure you were like, wow, I didn't think it was going to be like this, and I'm learning all these new things about entrepreneurship and legals, etc. What was sort of, very surprising when you reflect on that?
I think I found that our process was extremely challenging, and partially because I was not prepared for what we were going to have to go through. I was probably still a bit naive, and I think I am slightly naive today, that if you do the right thing, if you're honest, if you're truthful, that good things will come your way and people are going to treat you well and everything's going to work out fine. And that's not the real world. That's not the reality, right? So in our process, we started by getting the broker, we engaged, we got kind of the first key milestone was a letter of intent. The buyer, Pick and Pay, provided us a letter of intent that they wanted to buy our business, and it gave a broad understanding of what they were willing to value our business for. And we had a kind of broad deal on the table that we were then using to go into a full due diligence process, right? During the due diligence process, we're months into it now, the key stakeholder at Pick and Pay changed. And
sorry, Vince,
they basically...
Just for those people who don't know what due diligence is, maybe you can quickly give an overview of that, because I think, when I started IX, I didn't really understand that term. And I think entrepreneurs, if they know that they have to go through a due diligence process when they sell, they might actually start preparing a little bit earlier so that it's like quite easy to do that, because it can be quite a tedious process.
You're right. It's an extremely tedious process. So when a business gives you a letter of it, I guess the first key milestone is you've heard that there is a potential buyer who's interested. To get them to the real negotiating table and to really kick things off, you want to get a letter of intent which states their intent to buy your business and on kind of a broad spectrum of what those terms will be. From there, the buyer would normally put you through a due diligence process where they ask a lot of questions and expect a lot of documentation and supporting information from you to be compiled and sent to them. Everything from your management accounts and P&L, your projections, to your strategy, your marketing plans, your team organogram, anything you can think of, they will ask. And when you think you provided enough, they will ask more. Extremely tedious process and quite a lengthy process. And it requires a lot of documentation that I think most entrepreneurs actually don't have, because you're so busy running your business and you have these ideas in your head and you know what you're doing, but you haven't compiled it all into beautiful, neat presentations or Excel sheets or documents, right? So to your point, I think it's a really good idea that the more you can document and structure through your journey, the more prepared you would be for that. Our broker,
Yeah.
when came on board, actually helped us with that. And I think
Yeah.
another key insight for me is getting the right broker is so important, because before we even got into the due diligence, our broker helped us prepare our story, our pitch deck. He went through in a lot of detail our P&L, our profit and loss statement, our management accounts. He asked us for more information and helped us build a lot of the documents that we needed and didn't have because we were still so busy running our business. So that when we got into the due diligence process, we had maybe 60, 70% of it already prepared with our broker, ready to send to them.
Yeah, yeah. So that's good. I think, for people looking to sell even in 2 or 3 years' time, start understanding the due diligence process. And I think the most important part of that is getting your financials in the right, format, because ultimately a buyer is going to care about one thing more than anything else, and that's your financials. And how are they structured? Are they audited? Does it make sense? And, is it legitimate? Because, you're buying an asset, and that asset has a history, and that history is your financials essentially. So it's one of the things I had to learn as well, is like, that is so important. Like, every time you spend something in your company, put it in the right category, make sure it's got the right type of process in place, so that you can spit out your last 3 years of annual financial statements, show your revenue, show your profit, show your costs. And that's really the basis and the skeleton of how you build your your story around.
Agree fully. And I think even to take it a step further, I believe that your financials and your profit and loss statement are a strategic tool to run your business. And I think I learned that very early at Unilever. When you manage a business, you manage a P&L first, right? And when you build a strategy, it needs to be in your P&L. You can't just have these great ideas, but you haven't planned for the marketing spend or the team growth or the risk that this decision could come with. So we were fortunate that we always used our P&L or management accounts as a tool to manage the strategy of our business. But we also didn't do it in enough rigor that a big corporate would want when buying a business. So there was a massive auditing process of our financials that we had to go through during the due diligence, which was very difficult. I mean, they ask you for every receipt and note from like 3-4 years ago of what you did at this time. So it is an important thing to do. And the earlier you get a good accountant or a good partner to help you structure your business financially correctly, the better.
Yeah, I think you can also get, fractional CFOs that can come in and help you, prepare your business from a financial point of view and make sure that those things are all in place. If you say to them, look, I'm looking to exit in 2-3 years, how should I set up my financial tools and instruments so that I can be well prepared for, presentations and looking at our historical data. So yeah, just an interesting sidebar on the due diligence process there, which I think is, it's like coming back down to earth. It's like, hey, we want to buy your business, but we need 6 months of data to prove that you're telling the truth, which is can always be a little demotivating in the middle of the process.
And your any skeletons in your closet will come out in that process. So rather front up with them in the start with an explanation as to why, then try and hide them. Because trying to hide your skeletons and then they come out, you lose trust from the buyer in whether the entire story that you're telling is truthful. And you may have done it for the right intentions. Maybe something happened and they weren't going to understand it, so you wanted to hide it from them. Don't. Rather, my advice would be be honest about all of it up front, because I think it'll go a long way to buying you trust with the other party.
Okay, so I interrupted you in the middle of the selling process. So you got the letter of intent, you went through the due diligence, you kind of went back and forth on the valuation. What happened next?
We had kind of a broad terms of agreement for the deal on the table that we weren't thrilled about, but I think we got most of the parties between the buyer and our investors on board with. And at that stage, at Pick n Pay, the key stakeholder running the negotiation changed due to medical reasons. Actually, the person who was negotiating with us had to leave. And the CFO of Pick n Pay then came in, and she completely changed the deal on the table for us. now you're 3-4 months into a negotiation, in the middle of a due diligence. To have a deal change at that stage really put a bad taste in our mouth, put a bad taste in our investors' mouth, and it made it difficult for us to go forward from there. I guess from our perspective as founders, we were primarily driven by fear, if I'm honest, which I wish we weren't, but we were. We were scared that globally the world is falling apart. There's this pandemic. We were scared that we had put so much time and effort into this business, and if we don't get this exit successfully, the whole thing could fall apart. We were scared that we had 30, 40, 50 people working in our business, families to look after. So fear was our primary motivator and meant we were looking to close the deal no matter what. Our investors were giving us the advice that the new deal doesn't make sense, you shouldn't do it, and you should walk away from it. So we were kind of at odds with our investors in that regard, which made it difficult. Primarily one investor, the last investor that came in, who had obviously bought in at a higher valuation than the others and was looking for a return, and this new deal was not giving him the return he wanted. And actually, I look back at that and I go, in fairness to him, he was right to go, this is not worth my while. I'm not aligned to this. I'm going to tank the whole thing. But at the time, I
Is
felt
that what
very
happened?
angry. That's exactly what happened. When the new deal came back, he wasn't very keen on the first deal, but we got him there because of the circumstances we were in. And the second deal came and he said, guys, I'm not on board with this at all, and I'm going to tank this whole deal. And that set us off, right? So now we were having fights with Pick and Pay because they pulled the rug out from underneath us and changed things last minute. And then we were having fights with one of our main investors who said, I'm not going to be on board with this. And the whole thing felt like it was going to fall apart. And that took its toll. Whilst trying to run a business still, you're dealing with, you feel like you're in the middle and you're getting fucked by both sides, if I'm honest. So it was really difficult. And I can now look back at it and understand both sides, but at the time I didn't. I was very angry. We ended up having to take part of our earnout and fund it to the investor to give him his return so that he would come on board with the deal and that Pick and Pay would go ahead. And that felt wrong to us because we had put all of our blood, sweat, and tears into this business. We were far less financially well off than our investors were. So for an investor to demand of us a portion of our earnout to cover his return that he wanted, to us felt wrong. But again, I look back on that now and I go, well, when he invested, he had a plan for what his return was going to be. And if we were clearer and more aligned on that then, when the deal changed, we should have been aligned with him and said, you know what, we're not going to be driven by fear. We're going to be united as a board against the buyer and say, we're going to walk away from it if that's the case. I wish we had the strength to do that. Today, I think maybe I would do that. I don't know if it would have had a better outcome. I think maybe the deal would have gone south. We would have run out of money and our business could have failed, to be honest. But at that stage, we were too scared to do that. So we kind of made it work for all parties at our expense, which wasn't a good idea.
So how was the deal structured in the end when you, look at the earnout? Because I think that's also a subject that isn't super clear. It's like, okay, well, here's a value for your business, but we're only going to give you some of it, and the rest of it you're going to have to work for us, achieve specific metrics, and based on those metrics you'll get some more. How was that structured for you?
So look, the first deal was structured that they were going to buy our company as an entity. They were going to keep it separate, and there was going to be three tranches to the deal. A first purchase of, I think, roughly 50% of the company, followed by another 25% and another 25%, based on achieving targets and valuations linked to each of those. That was a deal I think we were quite happy with because it meant a couple of things. One, we could remain a separate entity to Pick and Pay. We could keep some of our agility and our startup feel as a business, and we wouldn't be tied into a lot of corporate governance and processes that would slow us down. And two, we obviously then could push for the maximum on the second tranche and the third tranche if we delivered those numbers. And we felt that the numbers that were set there, which were based on our projections, which they wanted to use a much lower version for a low valuation, we were going to smash those targets. We knew we would. So that deal kind of worked for us, that we would be getting more in the second tranche and the third tranche in the second year and the third year. And so would our investors. For us, that kind of made the most sense. However, they then changed the deal and said, no, we're not buying your business as an entity. We're buying the assets out of your business and we're leaving your business as a separate entity. That meant that all of our staff and us had to move across and actually be Pick n Pay employees. And that also meant that for our investors, they were getting a one-time purchase of their shares. They still structured the new deal that as founders, we had an earn-out tranche on the second year and the third year, but those were no longer share buyouts. Those were now bonuses. And those bonuses come with a much higher tax than if they were buying, if it was a second and third share tranche buyout. So the new deal was not only at a lower valuation, it would meant less money for us and our investors, which is where I think it soured a lot of things, and it was a lot more complicated. From Pick n Pay side, the reason they changed the deal in that manner was we were a small business with a lot of risks, and they didn't know what skeletons may be in our closet that they wouldn't see. So they felt buying the assets out and moving it across meant that if there were any skeletons, they wouldn't have to deal with them. It was a safer deal for them. So I understand that now. I didn't understand it at the time. For our investors, they got a lump sum payout at that valuation then, as we did too. And then we had a contract that meant we needed to remain with Pick n Pay for, well, we didn't have to, but we had a payout after the first year and a payout after the second year if we delivered targets. But yeah, those payouts were obviously a lot smaller than what they could have been, and they were taxed at a much higher rate. Fortunately for us, we over-delivered our target so much after the first year that Pick n Pay actually came to us and said, we're going to give you all of your long-term payouts now because you've completely over-delivered on the targets already, which was good. But yeah, there were lots of little intricacies that we had no idea about the implications of.
Yeah. So what role did the lawyer play in drafting all these contracts? Because, I'm listening to you now and I'm like, wow, this is a relatively complicated structure, moved between different formats. You've got a lawyer in the middle and they've got their lawyer, and now you're trying to agree to these terms, and what happens if you don't get this, and when you do get this, it triggers something. I'm just trying to understand, what was your relationship with the lawyer? Because you've got the broker and then you've got the lawyer. And how did you guys work together to create something that you were happy with when you signed the deal?
So our broker had a lawyer that they normally work with in deals that they brought on. We met her and got along very well with her too. So we used her in that process. Pick n Pay had their own legal team too. I think a lot of these structures and buyout clauses and how the implications of them, we did not understand at all, and we were learning on the fly. And as the deal kept changing, I think even our brokers and our lawyers didn't know the full extent to what it was going to mean all the time, and it meant a bit of back and forth. So each time something changed, we would then need to take the changes to our investors. And then one of our investors who's got a lot of experience in this would go, okay, but now that this is the case, I'm going to have to pay more tax. And if I have to pay more tax on this, I'm not happy at that price anymore. I want 20% higher to cover my tax. There was so many complications in that sense that to this day, I still don't understand, frankly. And I think what it is important there is if you have the broker and lawyer who understand that very well and share that with you, because otherwise you can sign a deal and think you're going to get something and you're not going to get that because the structure is completely different. Even something as simple as tax implications of a deal. One of the first pieces of advice I got from one of my early investors was to create a holding company for mine and my co-founders' shareholding and keep our shareholding not in our personal space, but in the holding company. I didn't understand why, but we did it. Then when we got to the sale, I was told, well, because there's a holding company, you're going to pay corporate tax on the sale into the holding company. And then when you try and pull it out to yourself,
You're
you're
gonna
going to
pay
pay
income
capital
tax.
gains tax. You're going to get double taxed. And I was like, but I thought the reason for doing this was to pay less tax. So these things are super complex. And then
Yeah.
look, our investors were like, there's ways you can, what is the right thing to say here? There are ways that you can reduce your tax
Tax. Yeah.
obligation with a holding company. And what you do with your money, if you don't pull out your holding company, is a way to manage that. So these things are super complex. I wish I'd probably understood them better and read up more upfront so that the way we structured our business from the start was better. But I don't know how I would ever have understood that. I don't, to
And
this day, still understand it very well.
yeah, if you had to start again, like with bottle shop, how would you structure it actually?
I've been fortunate to invest in a small business with a friend in the data and AI space, and it's been very interesting to see his journey because he is quite a studious guy. He studies a lot of different structures, and through the process with him and one of the other investors that we have, who is a finance guy, I've learned a lot more about how to structure your shareholding, how to process deals, how to create equity pools for staff and rewards. So there's a few key things I think I would do differently. The first is if I'm going to start another company, I probably want to register it in Mauritius or in a country where there are less lower tax obligations. So setting your company and having the core base of it in Mauritius means you're going to pay much lower corporate tax. There are things you need to do to be able to achieve that, but I think the benefit for you is going to be quite big if you can do that. The second thing, which I've learned recently, is that in the early stage, as a founder, it is quite important to create an equity pool for early staff that come on board that are really important to your journey that you're going to want to reward. Because down the line, if you aren't able to free up equity to give those people, there's a good chance you're going to lose them. And it is
Yeah.
quite difficult when you have external shareholders involved to go, hey, I want to free up 10% equity to be able to reward key staff who've been there part of the journey. And they're going to go, well, I don't want to dilute, you dilute, right? So
Yeah.
the earlier you set up a structure to do that, so that when investors come in, that structure's already there, the better, because then everyone's on board with it. And this is something I've seen my friend do, which has been a big, big learning for me. Um, and the third one is to really find good accountants and legal people that can help you on the journey early on. And it doesn't have to be
Mm.
expensive. I mean, we started with a company who did our accounting very early on, who they manage all of it through cloud software called Zero, and they're not full time to you; they consult to you. So the rates are much lower, but they have a broad team of individuals who can give you advice on the different things you're going through at the different stages of your journey. And I think having a good accounting team to understand those structuring, a good legal counsel, which you don't have all the time, but getting a reference of a person who you knows from someone else who's used is really good and who has the right experience you need. That when you need, you can go to them and get the advice you need, or get the documents drafted, or contracts agreed is really, really important. Yeah.
Yeah, just for reference, the type of lawyer you're looking for is specifically an M&A lawyer, I think, when it comes to this process, someone who's actually done more than 20 to 30 transactions, who understands the M&A process, because I think that's pretty niche when it comes to, specific skill set of a lawyer.
Yeah, I agree.
Okay, so I can imagine, and I can't believe we've been speaking for an hour already. I've been so engrossed in the story and unpacking this. It's gone by so fast. I think into the kind of next little bit, and most likely we'll do like another 15 minutes, is to talk more about the post-sale journey, which I'm sure is an emotional experience. I can imagine I haven't sold my business yet, but I'm very attached to it. I've put my heart and soul into it, most likely like you did. There's an attachment to this thing that you've created from an identity point of view. Um, and yeah, I would love to understand, what were your feelings afterwards, and how have you processed this whole experience?
Um, this podcast weirdly has actually been a good piece of therapy for me to look and reflect back on the last few years in the journey and kind of process some of the difficult things we've been through. This conversation, I think, is also helping me do that. Um, and I think, weirdly, looking back, when you start a business, you think all you ever want to do is exit this business. Post exiting the business to Pick and Pay, I felt that I was probably the most unhappy or the most lost and directionless I'd been in my entire life. Um, and for me, from a young age, I had direction. And that direction really was that I needed to make money to be able to look after my family, both my existing family and if I want to have a family in the future. And I wanted to be able to do that to make sure if I ever have kids in the future, they won't go through what I did. Because it was, for me, I was in an environment with people with a lot more than me, and I'm not saying I was the worst, but I was the worst off ever. But in that environment, it made me super insecure, and it was a defining part of my life. But that gave me a lot of drive and motivation that I was going to be successful. I was going to make money so that I could look after my family. I mean, I was contributing to my household from the age of 15 already, and I was fully looking after my parents already from the age of 21. So that gave me drive and purpose. And that, when I started a business, the most difficult thing was I was giving up a corporate job and corporate shares that was comfortable, it was safe, and it was allowing me to do that, to take this risk that if it failed, it wasn't just me on the line, it was my family's life on the line. Um, and that, in a way, again, is such a great motivator that I was never going to fail. I was going to push through every barrier I had. So, getting to the point of exiting my business was one where I thought that I should have been the happiest and most fulfilled and felt like I had achieved something. Whether I got the financial success or not is irrelevant, because your view of financial success keeps changing as you grow. If 18-year-old me looked at where I am today, I would think I've done phenomenally well and I should be proud. But today I look at it and I'm going, there's so much more I could have done and want to do. So it's a slippery slope of what your expectations are and what you're looking for. But I expected post sale to kind of feel some level of pride and reward, and I did to a degree, but I mostly felt lost because I had the singular purpose of making this business a success, and I had this responsibility of this team who relied on me, and jobs that relied on me. And post the sale, I felt like, well, I still have this responsibility because we were still involved in the business. We were still running the business now within a corporate, but it didn't feel the same. And I have still felt a little bit directionless of what am I doing with my life and what is my goal? Because in that process, I realized that I had a very superficial goal that drove me. Making
Mm.
money is a superficial goal. And when you achieve some level of financial success, it does not give you what you think. It's not to say that you should not chase financial freedom. I still want financial freedom. I'm still chasing it. But the pursuit of money is not going to give you the fulfillment you think. And for me now, I'm looking for something more meaningful of what I want to spend my time and my skill set on. I want to make a difference. I want to make a change. So I'm kind of in that headspace of trying to figure out what is next and how do I recreate that purpose and that drive that I once had
Yeah.
behind something that is more kind of intentional and at my own choice, not for the sake of I have to.
Yeah, look, I mean, I think taking the risk to start a business and being an entrepreneur in South Africa is a service to this country, creating value, creating jobs. And that's what this country needs. It needs more entrepreneurs. It needs more support for entrepreneurs. The small to medium enterprises are what can fuel this economy and actually change this country. And I applaud all entrepreneurs for taking that risk in quite a difficult environment where capital is hard to get hold of, talent isn't easy to find, product market fit isn't like the US. So you've kind of got the odds stacked against you in a way in this country in terms of being very successful as an entrepreneur. So, I think what you've achieved is remarkable, and to have actually ticked the exit box, in my opinion, of someone who's going to hopefully do it, is a big check box on your journey. There's so many more companies you can help sell or start or grow. And I think, you might even underestimate how much knowledge you have. Like even just having this conversation, I'm like, wow, this is incredible to listen to this journey and to understand the intricacies and the nuances of starting a company, going through COVID, um, you know, getting almost into a hostile takeover from a corporate partner, having to negotiate in very trying situations with multiple types of people. These are all incredible experiences, I think, on the entrepreneurial journey. So, I'm really amazed by just the content and the experience that you have.
Yeah, and like I look back at it, and as much as I wish things had gone different here or there, I wouldn't change things for the world because they happened the way they happened based on my own decisions and expectations. I'm a big believer that I can't be a victim to circumstances. So for quite a while, I was bitter and resentful and angry at either Pick and Pay or our investors for the negotiation and the process and the outcome. And for completely the wrong reasons. I had to look at that and reflect harshly on myself and go, I chose to start an alcohol delivery app, which put us into that block, and we struggled to raise money often because it was alcohol. I chose to
Mm,
partner with Pick and Pay because they were the best partner we had at the time, and they had not acquired a business in 20 years prior to us. Um, so to think that they were going to act differently, they're a big corporate. They're going to negotiate hard. That's normal.
yeah.
For me to get angry at my investor for turning on us when he was not getting the return he would expect. And if I was him now, I can understand how he acts. I can look back now and understand all of that. But for a while, I was holding on to a bit of anger and resentment. And it took me reflecting on this whole journey I've been on to go, what am I doing? I am so thankful and grateful for the journey I've been on. I have learned so much. I've grown so much as an individual. I've been able to fast track my career. I've been able to hone in a skill set in certain spaces which a lot of people don't have. And I was able to have a positive exit that has allowed me to continue to look after my family and now look forward and go, I want to focus uh, on things that of my choice. That I've achieved all of that, and I'm actually super grateful and thankful to the journey and process. And I wouldn't change it because I don't think, with the knowledge I have now, you can always look back and go, hindsight is perfect vision. You do things differently, but I didn't
Mm.
have a different view back then, and I had to go through those learnings and those hardships to be where I am now. So this discussion has helped me reflect a lot on that. Actually, thank you for that.
Yeah, no, it's been so interesting. I think maybe as kind of like a final piece, if you talking to a entrepreneur who's looking to sell their business and achieve that milestone of liquidity, and you're like, okay, here are my key pieces of advice of someone having gone through it. This is the best I can give you. What would that be?
Good question. Um, I'm going to spit out a few things. The first is, if you're going to look to start a business, the best piece of advice I give to anyone is to find a co-founder, because the journey is going to be way harder than you think. And everyone will tell you that, and you're not going to believe it. And that's good. You're going to be naive. You're going to go ahead, but the journey is going to be very difficult. And having a co-founder that can, someone with a complementary skill set that can pick you up when you're down and that you can pick them up when they're down, for me was one of the best things I had in this process. And I would recommend it to anyone because the journey can be lonely and difficult. So get a co-founder is the first thing. Second thing, make sure you get your financials right, structured correctly early on, because it is much harder later to get that right and to fix things. So ensure you get the financial structuring and shareholder structuring of your business right early on. The third thing I'd say is be intentional about an exit. We weren't ready for an exit, and it was forced upon us by the environment. COVID happened. And then we were kind of playing catch up. But I think if you want to exit your business, like anything in life, you should prepare for it well in advance. And you don't know how to prepare for it, but it starts with going, I want to exit in 2-3 years. And it starts by going, well, just like starting a business, you don't know what you're going to do the first time you do this. You don't know how to register a company, create a domain or a website. You don't know these things, but entrepreneurs, your mindset is, I'm going to figure it out. Do the same with an exit. Start 2 years in advance and going, I want to exit. What are the steps I'm going to take? Google stuff, research, speak to friends you potentially have. Come and listen to this podcast and get the advice. And rather start many years in advance of where you want to be, so that when you do get there, in the event that you do get there, you're going to be so much more prepared, and hopefully the journey will be better. And the final piece of advice would be to find a really good broker when, and you can find the broker before you're ready to sell, right? You can meet brokers 2 years in advance, and the broker will actually help you prepare over those 2 years for the exit, and will help you figure out who are the potential buyers of your business, what are your strengths, what are your weaknesses. Find a broker in that journey early on. And then the last thing is, the advice we got from our investors was, one of the most important things that a potential buyer invests in is the founders. There are potential assets or intangible assets or tech that your business has that's valued at something, but the most important thing is the founders, that founding team. So the advice we got was to actually get a PR company and to start PRing ourselves and building our personal profiles in advance of the sale. Now, it would have been great to do that 2 years before, but we did that in the moment of doing it. But I still think it helped a lot. And I would recommend the same, is if you're looking to exit, become a founder and build your profile and persona of who you are, that you are infinitely investable as an individual. So that, because a lot of your valuation and a lot of the success of whether you're going to exit or not is going to be based on you, not just the fundamentals of your business or the assets in your business. It's going to be based on you as a founder. The more you can build a story and a narrative around why you are the best at what you're doing and why you're going to be successful, and you have that passion and the drive, the more buyers are going to want to seal a deal and get behind you.
Yo, that is power advice. I haven't even thought about doing a personal brand PR strategy, but it makes perfect sense. Like, build your story, build your narrative. Investors invest in people. And then I think that the second thing there is, starting the exit strategy process early is gonna, can radically increase your valuation at the end. And there's a book I read that actually inspired, me to start this podcast, which is called The Exit Strategy Playbook by Adam Coffey. And he's exited quite a few companies, and basically says, if you can just put this playbook together and understand that it's going to take 24 to 36 months, and you start preparing now, you can have a radically different outcome in the end. And that's really the point of this content, is to help younger entrepreneurs or people who have businesses that haven't thought about selling them, or don't understand it, or just too scared to really approach the topic, to take that leap forward and start demystifying it, getting the tools, understanding the knowledge, and preparing their companies and their mindset to be successful in the end.
Yeah, I also think, advice we always got was, when looking to raise capital, get smart capital and get investors that can add value. And it was always just this weird thing that we were like, yeah, but we have a plan and we know what we want to do, and really we just need funding. And what value are investors going to give us? But actually, finding investors who have been successful entrepreneurs that can give you the advice and mentor you, and even though you're not sometimes ready for the advice, having that guidance there will really help. And having a group of people you really trust is important, because things will get difficult. Incentives will change between the different parties. And you don't want to be in a situation where you are at odds with your own board. Trust me, I was there, and you're fighting battles on two sides. It's not great. So choosing wisely who you bring on. I mean, as a first-time entrepreneur, we were just looking to get capital anywhere we could. And that is often what I think many startups look at. But try and think beyond that of, are these people you trust, and do these people have experience that can guide you through the journey? Because there's going to come a time when you need to rely on it very heavily, and it'll make a big difference.
Agree 100%. Well, Vince, 1 hour, 18 minutes. thank you so much for coming on the show and being honest, open, and sharing your story for other people to learn from. I really appreciate the time. And yeah, I look forward to grabbing a coffee and talking some more about the experience.
Yeah, thank you for having me, and I'm excited for your journey. Hopefully, one day I'll come back post your exit, and you can
Hopefully,
share your story with me.
I will do that happily. All right. Thanks, everyone. I hope you enjoyed the show.
Cheers.